What if the very companies driving the artificial intelligence revolution are now the biggest threat to your equity portfolio? That is the bold signal coming from Commerzbank analysts this weekend. In a note released on Friday, July 24, 2026, the German banking giant highlighted a critical combination that equity investors cannot afford to ignore: mounting stress among the world's largest cloud computing firms, the so-called hyperscalers, combined with dramatic volatility in the semiconductor sector. This is not a distant, hypothetical risk. With global equity markets opening on Monday, July 28, the implications of this analysis are landing directly in the laps of investors right now, on Sunday, July 26, 2026. Commerzbank's warning follows a week in which chip-related stocks and big tech indices showed renewed signs of instability, raising urgent questions about whether the AI-driven bull run has extended further than the fundamentals can genuinely support. Stay with us, because by the end of this video you will have a clear understanding of what is happening, why it matters, and what it could mean for your investments. Before we can understand the stress Commerzbank is flagging, we need to be clear about what hyperscalers actually are. The term refers to the handful of technology giants who operate the world's largest cloud computing infrastructures at a genuinely global scale. We are talking about Amazon Web Services, Microsoft Azure, Google Cloud Platform, and Meta's vast data center network. These companies are not simply technology businesses. They are the backbone of the modern digital economy. What makes them so significant for equity investors is their sheer weight in global indices. Between them, these corporations account for a substantial slice of the S&P 500 and the MSCI World Index, which means that hundreds of millions of pension savers, ISA holders, and institutional fund managers around the world carry direct exposure to their performance. When Commerzbank says hyperscaler stress, they are in effect signaling potential pressure on the broadest equity benchmarks that most ordinary investors track. This is precisely why the bank's analysis published this Friday deserves serious attention from anyone with money in equity markets. So what exactly is stressing the hyperscalers? Commerzbank's analysis points to several converging pressures. First, there is the extraordinary level of capital expenditure these companies have committed to in their race to build AI infrastructure. Amazon, Microsoft, and Google have each announced multi-billion-pound data center expansion programs in 2025 and 2026, with costs escalating as they compete for the same finite supply of advanced chips and electrical power capacity. This spending is beginning to weigh on free cash flow metrics, which are a key measure analysts use to assess the underlying health of a business. Second, there is the critical question of revenue return on this investment. Investors are growing impatient for clear evidence that all this AI infrastructure spending is actually translating into meaningful new revenue streams. So far, the results have been mixed. Some hyperscalers have shown strong cloud growth, whilst others have struggled to justify their elevated valuations against a backdrop of softening enterprise technology budgets. Add to this the broader macroeconomic uncertainty, and you have a recipe for sustained investor anxiety heading into next week. The second major theme in Commerzbank's warning is chip volatility, and this is where things get particularly complex. The semiconductor sector has been one of the most dramatic stories in global equities over the past 2 years, driven almost entirely by the insatiable demand for artificial intelligence processing power. Companies specializing in advanced chip design have seen their valuations reach levels that would have seemed extraordinary just a few years ago. But volatility cuts both ways. The very factors that drove chip stocks to record highs, namely AI optimism and aggressive hyperscaler procurement, are now creating severe instability when that optimism shows any sign of wobbling. When hyperscalers pause or revise their chip purchasing plans, even marginally, the impact on semiconductor share prices can be swift and deeply punishing. This dynamic creates a feedback loop that amplifies stress across the entire technology equity complex. Taiwan Semiconductor Manufacturing Company, which produces the advanced chips at the heart of the AI boom, is one of the most closely watched bellwethers in global markets. Any disruption to its order book or production forecast sends immediate ripples through equity markets from Tokyo to London. Understanding the linkage between hyperscaler performance and broader equity markets is crucial for any investor watching this situation develop. Because technology companies now represent such a large proportion of major indices, stress in this sector does not stay contained within tech. It spreads. When chip stocks fall sharply, it weighs on broader U.S. technology indices, which in turn influences global risk appetite. For British investors specifically, whilst the FTSE 100 has less direct technology exposure than its American counterparts, it is far from immune to these pressures. Many FTSE-listed financial companies, asset managers, and pension funds hold significant positions in U.S. technology equities as part of their global allocation strategies. Beyond direct holdings, global risk-off sentiment triggered by American tech stress tends to pull down equity markets worldwide, including in London. It is also worth noting the currency dimension here. A flight from risk assets often strengthens the US dollar, which in turn affects the earnings of FTSE 100 multinational exporters when those figures are converted back into sterling. The interconnected nature of modern equity markets means this is a genuinely UK-relevant concern, not just a Wall Street issue. One of the key contextual factors amplifying all of this is the current stance of the US Federal Reserve. Analysis published alongside the Commerzbank note this week confirmed that the Fed is holding interest rates steady while carefully monitoring ongoing inflation risks. This matters enormously for equity valuations, particularly in the technology sector. High-growth technology companies are typically valued on the basis of future earnings, and those future earnings are discounted back to present value using prevailing interest rates. When rates remain elevated, those projected future earnings are worth less in today's money, which creates persistent downward pressure on valuations. The Federal Reserve's cautious, wait-and-see approach means that the one catalyst which could most quickly relieve pressure on technology valuations, a definitive rate cut cycle, is not imminent. Markets had been pricing in at least one or two rate reductions before the end of 2026, but persistently sticky inflation data has forced a recalibration of those expectations in recent weeks. For hyperscalers already facing operational and revenue stress, this macro backdrop removes what might otherwise have been a supportive cushion for their equity prices. Looking at what lies ahead in the near term, investors should focus on several key developments. Earnings season for major U.S. technology companies will be a critical moment of truth. Hyperscalers typically report quarterly results between late July and early August, and the figures due over the coming days will either validate or directly challenge the concerns Commerzbank has raised. Specifically, watch for any signs of capital expenditure cuts or delays, any softening in cloud revenue growth rates, and any cautious guidance language around AI monetization timelines from executive teams. On the chip side, pay close attention to semiconductor order book updates and any revised production forecasts from major manufacturers. The Philadelphia Semiconductor Index, commonly referred to as the SOX, is a reliable real-time barometer of sector health and is worth monitoring closely through this week. Beyond the immediate earnings window, geopolitical developments remain a significant wildcard. Any escalation of tension affecting advanced chip supply chains would immediately amplify existing concerns. And in the United Kingdom, any shift in the Bank of England's rate outlook could alter the relative attractiveness of equities versus fixed income for domestic investors managing their portfolios. So let us bring all of this together with a clear and practical takeaway. Commerzbank's analysis from July 24, 2026 is not a prediction of an imminent crash. But it is a serious and credible signal that two of the most important pillars of the current equity bull market, the hyperscalers and the chip sector, are showing signs of stress simultaneously. That combination, happening against a backdrop of elevated interest rates and growing investor impatience for AI revenue returns, creates a genuinely challenging environment for equity investors heading into the second half of 2026. The intelligent response to this is not panic, but it is certainly not complacency either. Review your portfolio's exposure to concentrated technology positions. Ask yourself honestly whether your risk appetite genuinely matches the level of volatility you may be about to experience. And keep a close eye on the specific data points we have outlined in this video, because over the coming days and weeks they will tell us whether Commerzbank's concern was well-founded or premature. If this analysis has been useful to you, please give this video a like and subscribe to the channel for expert financial market coverage every single day.